I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today, I'm talking to Cathie Wood, the CEO of ARK Investment Management and active ETF superstar. You might know Cathie for predicting back in 2018 that Tesla would hit $4,000 a share. She hung on amid a torrent of scorn on social media. Now that, and many of her other bets on disruptive innovation, are paying off massively. Cathie's biggest ETF has returned well in excess of 100%, and ARK's assets have swelled to $50 billion.
We still think there's a lot of room or runway ahead because what we think is not well understood is exponential growth.
Cathie has confidence. We talked about the genome stocks she thinks can outperform Tesla, how ARK uses social media to such great effect, an ownership dispute that threatened her firm, the one thing every woman in finance should want. Here's my conversation with Cathie Wood. You're having one of the best years in the history of professional money management. What's it like?
Oh, it's been unbelievable. The coronavirus created tremendous number of problems, and our portfolios are all about solving problems. And our investors have been rewarded for helping to solve some of the world's most profound problems.
What about on a personal level? Are you enjoying the celebrity?
Am I enjoying the celebrity? It's fun. I love what I'm doing. That's the first thing. I love the team I'm working with. I love our research. I love bringing to life new ways of looking at the world, helping people understand, how the world's going to change, and not only in their investment portfolios, but also in their own lives, their children's lives, their grandchildren's lives, helping them understand how to move everyone to the right side of change and really benefit from the exponential growth trajectories that are just taking off now.
It's okay to enjoy being a rock star, even if it's just for a moment, right? You're enjoying potentially life-changing success.
Most certainly, but I have been around the block a few times, the track a few times. And whenever things have gone this well for me, usually there's a correction around the bend, and I want to gird for it and protect it, and also prepare our investors for the possibility and say, just keep some powder dry, because what we're looking at here are long-term, again, exponential growth trajectories that they're not going to be stopped. You can't stop progress. And today, when the government tries to stop progress, it usually fails. And so even if we go through a correction, and I expect one, we must almost always expect corrections. I just have to keep my eye on the prize. But I do want to warn investors that, in the investment world, it's not just straight up and to the right. We will have those corrections. So again, we just keep our eye on the prize. We have a 5-year time horizon. We are fully invested at all times, which is what we are supposed to be. But that doesn't mean that investors shouldn't, sometimes take a bit of money off the table and keep some powder dry.
I know you're aware, Cathie, that the market doesn't give second chances to superstar managers who stumble. Ken Hebner is one who comes to mind, right? He was never able to rebuild the asset base that he had before the financial crisis. Neither was Bill Miller, for that example. Is that something that concerns you, the consequences of having a bad year?
Well, one bad year would not worry us at all. Our investment time horizon is 5 years, and we have projections which we develop from the top down, trying to understand how technologies are going to scale, and from the bottom up, how companies are going to embrace these new technologies and ride their coattails. And just looking at the portfolios today, this is after the triple-digit gain, as you have said. For the next 5 years, we believe that our returns will compound at an annual rate of something in the low 20% range. And this is in a market where traditional equity returns have been in the 7 to 8% range over time. So we still think there's a lot of room or runway ahead because what we think is not well understood is exponential growth. I think if we step back and look at Amazon in the early 2000s, I remember buying that stock, and many people derided that decision because the thought process back then is in the tech and telecom bust, which is, the internet is a figment of Wall Street's imagination. What makes you think Amazon's ever going to make any money? And if you did at that time assume that Amazon's revenue growth would compound at a 20 to 30% rate for the next 20 years, you would have bought that stock all day long, even if you were using a dividend discount model, right? I feel like our portfolios are filled with Amazons because the seeds for what we are doing now, they were planted in the tech and telecom bubble, and they have been gestating all this time, and now they're breaking out to those growth trends, just like Amazon did.
So the portfolio may not be able to replicate the 500+% gain it's had in the past 5 years, but it should be, based on what you just told me, well over 100%. It should double plus in the next 5 years.
Yes, we expect more than a doubling in our portfolios over the next 5 years.
If I look backward, as you well know, Tesla accounts for almost a fifth of the return that you have generated in that 5-year time span. Which of your current holdings, Cathie, do you think will supply the biggest lift in the next 5 years?
Tesla's still in the running, but I would have to say the biggest upside surprises are going to come from the genomic space. And that's because the convergence of DNA sequencing, artificial intelligence, and gene therapies, importantly, CRISPR gene editing, are going to cure disease. That convergence is going to cure disease. Now we have real science and technology surfacing the mutations in our genomic profile. And as they surface those mutations, what do we see? We see the earliest manifestations of disease. And now, with the combination of artificial intelligence and gene editing, we're able to both anticipate diseases and cure them potentially. Beta thalassemia, we're seeing it, sickle cell disease. We even think it will work in diabetes, which is where most, if you look at the largest category of spending year to year in healthcare, it's diabetes.
Cathie, another surprise for me in your portfolio attribution is that almost none of your performance, just 20 points out of 600 points, is from Apple, Microsoft, Amazon, and Facebook, the 4 biggest contributors to the S&P 500 over the same period. What about them doesn't make the grade for Cathie Wood and for ARK?
Well, we're not saying they'll be bad stocks at all. In fact, they've been very good stocks. And they were a part of our portfolios in the early days. But as they were scaling into the $1 trillion category, we believed that our research would be focused better on the next set of fangs. And I don't mean fangs meaning in the internet age. We actually think the next fangs are in the genomic age. And if you'll notice our flagship portfolio, the largest exposure is healthcare for that reason.
What would make you reconsider investing in those stocks?
What would encourage us to move back into that ilk of stock is a continuation of what we're seeing now, so that some of our valuations become stretched beyond our minimum hurdle rate of return. So our minimum hurdle rate of return for any stock entering our portfolio is 15% at a compound annual rate over the next 5 years. So that's the doubling over 5 years. we're not there yet. But if we're in the low 20s, which is much more than a doubling over 5 years, but if we started seeing more and more of our stocks lose that return expectation and drop below 15%, we would move back towards some of the FANGs and Microsoft because we would be treating them essentially as cash-like instruments for our strategy. So what we do is, as a bull market extends, we do move into more cash-like equities. They would be the less volatile stocks, and certainly the FANGs and Microsoft fit that. And we would do that increasingly.
Bitcoin historically was a huge contributor to your returns, and I know you're still bullish on it because ARK recently published 2 very favorable white papers on Bitcoin. But so far as I can tell, there has been no Bitcoin in the ARK Innovation ETF for more than a year and a half. How come?
Yes, well, we put it in at a 1% position in 2015 when Bitcoin was $250. And we scaled with it. We didn't sell it at all. So it hit 10% of the portfolio, at which point we were forced to sell. And at the same time, there was some forking taking place. So we were getting distributions. And what we learned is that Bitcoin threw off what's called unqualified income, which is not illegal, but from an IRS point of view, if our portfolios generate more than 10% of gross profits in unqualified income, which is usually commodity-like income, the IRS allows that 10% and then will confiscate the rest of it. So if we moved into a black swan event where the equity markets imploded and Bitcoin took off, our clients would be able to keep only 10% of that gain. And we just thought this was too much of a risk from a fiduciary point of view to subject our investors to. So what we did is we moved out of it in early 18, better lucky than smart, because of course we went from $20,000 down to, at the end of 17, down to below 4,000 earlier this year. In our fully discretionary portfolios, where we are not subjected to the 40 Act rules of the SEC, our Bitcoin position is about 7% right now. So that is how optimistic we are on it.
And it's once again flirting with $20,000. Can you put a price on your level of bullishness?
We are extremely bullish. Our confidence in it has gone up since 2017, because what we saw as it dropped from 20,000 to below 4,000, it actually got well into the threes, I think in 2019, was that Bitcoin's share of the crypto asset ecosystem moved from the low 30% range in terms of value, network values, into the low 70% range. And what did that tell us? That confirmed in our mind that Bitcoin is the reserve currency of the crypto asset ecosystem. So it is the reserve cryptocurrency, which is a very important role. It's the flight to safety currency. It is Bitcoin's technology, or Bitcoin's blockchain, is the most secure of any other blockchain. And so it makes sense that Bitcoin would be the reserve currency of the crypto asset ecosystem.
Cathie, in August of 2018, you tweeted a letter to Elon Musk in which you effectively put a price target on Tesla of $4,000. And that call arguably made you famous, but it also exposed you to a world of hate on Twitter. Any regrets?
Oh, no, not at all. I didn't read the Twitter world of hate notes to me. Our marketing department used to send me anything that I needed to respond to. But no, we were standing up for what we thought was right. And we also were astonished that at the backlash And I think part of it was Elon's personality and the way and the things he was saying on Twitter. He's a provocative soul, and he's brilliant. He's our Renaissance man, and all we did. Which is what we should have done in terms of our research, is keep our eye on the prize. And the prize had to do with the autonomous taxi network that we believe Tesla will be in the pole position to dominate, mostly because of its advantages in artificial intelligence and the amount of data it has collected and the AI expertise that it has. And we couldn't believe that no one wanted to listen to this, that they really just made fun of it. And it made me feel even more strongly about Tesla, because what we saw happen over time as the naysayers were growing was their barriers to entry, or Tesla's barriers to entry, were increasing. Their battery technology was already 3 years. Now it's maybe 4 years ahead of the competition, especially now that they're going to build the battery into the structure of the car. They have the first AI chip. No other auto manufacturer has an artificial intelligence chip for autonomous. They now have 15 billion miles of real world driving collected. Google, the next closest, has about 25 million, 15 billion. The winner in autonomous is going to have the most data and the highest quality data. That company right now is Tesla. So way back then, our confidence was high that they were heading in the right direction. And as the naysayers grew, it was after 2018, through into 2019, as the stock was cratering, as many out there were saying Tesla was going to run out of money. We thought that was a ridiculous concept. The only time a company like Tesla will run out of money is if the market shut down. There were companies that ran out of money in 08, 09 because the markets were closed. The markets were open. We were going to support Tesla if they did an offering. So were many others. So, I mean, they were creating stories that were just ridiculous on the face of them. So, no regrets whatsoever.
Tesla is a great example of how you and your colleagues have harnessed social media as a tool for marketing, a tool to disseminate your ideas. Where do you figure ARC would be today without social media?
I don't think we would be as far as we are. I know we've been very gratified to see how beautifully we're scaling and getting our message out, which has helped our distributors, because we have a distributor here in the United States, one in Japan, who distributes for us through Asia Pac. We are known throughout the world. We are punching so far above our weight because of social media. And what's been fascinating about it is it has given us a competitive advantage because the compliance departments in other organizations will not let their portfolio managers or analysts talk about their research. We can't really talk about our stocks too much, but we can talk about our research. And that is giving us a competitive advantage in two ways. The reach that I just described, but also we're becoming a part of the communities we're researching. Our analysts, as they put out their research, not when it is finished, but as it is evolving, they are engaging with the communities who are actually making these innovations happen. And it's a beautiful dynamic, because what we're doing is we are educating those innovators about how big their markets are going to be, how quickly they will scale, where the barriers to entry are likely to be, what the competition looks like. And they are battle testing our assumptions. They're telling us if we've made an incorrect assumption, or they're telling us if we've got the technology right. So it's an incredible give and take. And I always thought that open source research, much like open source software, would be a very powerful dynamic in the marketplace. and it has been.
So hazard a guess for me. You've got 30 plus billion in AUM today. How much, where would it be without this community that you've created and the velocity that being on Twitter has provided?
Well, to be honest, we're up to 50 billion now.
Oh, if you add all the separately managed accounts and the institutional money.
Accounts, all the different strategies. I think we'd be a lot smaller than we are now. And I think that, what comes around, or what goes around comes around. We have really, with outreach as one of our ARC's missions and values, we have wanted to educate people, the average investor, about how their lives were going to change and how they might capitalize on these changes in their portfolios. And so I think there's a virtuous cycle at work here. And there's also a bit of a viral network effect taking place, which I think many in the financial world did not think could be a part of the financial world just because of our regulatory regime and so forth. But I do think it's happening, and I'm thrilled to be a part of it.
You believe there are 5 technology platforms that are changing the world: artificial intelligence, robotics, energy storage, DNA sequencing, and the blockchain. But of course, technology isn't static. Mm-mm. If there's a 6th, what would it be?
Well, we're looking closely at quantum computing because I've been in the business a long time, more than 40 years, but for the last 20 years of those, we've been examining quantum computing. I'd be at the World Economic Forum technology conference in China, and, professors from around the world focused on, the next big thing, quantum computing. It was always 10 years out, and it probably still is from a commercialization point of view, 10 years out. But now we have the first little baby rudimentary quantum computers. There's actually something physical out there working.
Active ETFs were pretty common back in 2014, but mostly in fixed income. There were very few in equities. Why did you choose the actively managed ETF as the wrapper for your strategy and not something else?
Yeah, it's interesting. We were looking after 0809 at AllianceBernstein, the research on strategic change team. So the thematic team was saying, okay, we have had a major disruption, and now technology will come in and take care of some of the problems caused by that disruption. And so what we saw happening in the financial services industry was a share shift towards ETFs. And just from a research point of view, we were asking ourselves, why is that happening? We didn't know anything about ETFs. And so we looked at what an ETF is and understood that there were 4 reasons that ETFs were starting to take share. They were more transparent, and after 0809, investors wanted more transparency. Investors wanted more liquidity. Unlike mutual funds, they trade all day long. They're lower cost than mutual funds because they didn't have any hidden fees. The fees, what you see is what you get. And they were more tax effective. And so for those 4 reasons, I just asked the question, why aren't we doing why don't we put our fund into an ETF? This sounds like a good deal for the end investor. And that's what got me questioning, hey, AllianceBernstein, what are you doing about ETFs? Are you thinking about active and so forth? And that's how we fell into that conversation. But it was from a research point of view.
I've wondered to myself why you didn't start a hedge fund, because from a purely self-interested standpoint, you'd be a lot richer at 2 and 20 than you are at 75 basis points.
I felt that the right thing to do was go where no one was. And I've had good success over the years doing that. If you see everyone moving in one direction, and sure, hedge funds have been so lucrative for asset managers. But if you see everyone moving into hedge funds and private, and you look at a new wrapper that's actually a good deal for the end investor, and you go with low cost and public, using the private market valuations as an umbrella, maybe, just maybe, you'll be onto something big. And so I think that's what happened here.
ETFs are by definition public market vehicles. I've wondered this as well. Why not extend your investment thesis to private markets and raise money to invest in venture capital and in growth equity, because so many of the things that you're interested in get their start there?
Absolutely. Well, one of the reasons was the low-hanging fruit in the public equity markets. Innovation had been neglected in the public markets. It had become overvalued in the private markets. My stomping ground was the public market, so it made sense for me to start there. Now that the valuation discrepancies are narrowing to some extent, not completely, and because we must know private companies. And in fact, part of our research ecosystem with the social networks, getting involved with companies as they're innovating. A lot of them are private, and we're talking to them regularly in on social media platforms. So yes, we are evolving some strategies. We hope that next year we'll be able to launch something. What I would love, and it would be true to our stripes, our current stripes, I would love, because I know the SEC is opening up to this, I would love to be able to offer a public-private option that would be available for all retail investors. Right now, the private world has to deal with accredited investors. So there's a screen. I believe that screen is going to start coming down over time. And I'd love us to move into a world where we could offer what we do across both public and private companies.
In the form of an ETF?
I don't think it can be done.
No,
in
probably not.
Yeah, just because of the way market makers and authorized.
Sure, the creation redemption mechanism.
It would be very difficult, but I'm sure that we could find some other wrapper, maybe a separately managed account wrapper, in which to make this happen.
Right now, Cathie, your ETFs alone are generating an annualized run rate of $220 million in revenue, and that doesn't include the other assets under management. How profitable is the business?
Well, our business is very profitable now, but believe me, the blood, sweat, and tears that we left in the early days, it's a scalable model. So we had to pay for the infrastructure in the early days, and we were quite the loss-making company. And I felt it acutely since I funded most of it for the first 3 years. But in those early days, we were investing aggressively, which is what we tell our companies to do, because we thought we would be able to scale. And when we were able to scale, we'd have the right talent in place to scale. And so we've done that. And I'm very happy to say that we are able to reward those who are making us happen, the team that's making this happen, and rightfully so. So in a way, the hedge fund model, you have maybe fewer people and less in the way of assets, and the same kind of profits. So we've done it a different way, and now we've shown it's possible, and we think it's a really healthy way to go as well.
Cathie, in the midst of the incredible year ARK is having, you're in a legal battle for control of your firm. How on earth did that happen?
Well, I will say that has quieted down, and we are in negotiations. I think all we wanted were negotiations, and we wanted to be fair and square with our partner. And I think things will work out. I think we're well on our way.
From your perspective, does working things out leave control of the firm either in your hands or the hands of you and your partners, your colleagues at ARC?
Yes, it does.
And if things were to go pear-shaped, and for your sake, I hope they don't, do you have a nuclear option? Could you just take the team, pack up, walk out, start a new firm, and create new ETFs?
I could not. I could not.
You have a non-compete.
And a contractual obligation.
Okay.
Yeah.
So both sides then have an interest in coming to the table.
Yes.
Cathie, ARC manages 5 active ETFs, all of which have more than $1 billion in assets. Are there any others that you have wanted to create, thought of creating, or in the process of creating?
Yes, and one of our partners, a distribution partner in Asia Pac, Nikko Asset Management, the Japanese market is a very interesting market. The clients, the investors, basically tell the distributors what they would like to see, and we've learned from them. So our fintech portfolio came out of Japan. It started in Japan in 2016 and in the US in 2019. They have a space exploration fund. We're looking at that one at some point in the next year or so, hopefully. And also an SDG fund we are likely to launch there, and SDG Sustainable Development Goals, the UN 17 goals. Our technologies, our 17 technologies map, or I should say 5 platforms and 14 technologies, so that'd be 19, map beautifully against those 17 goals. So it's a natural.
If you had to build ARC all over again, what would you do differently?
Oh, probably, well, we had to pivot because we sat in year 2.5. As I told you, I funded it for the first 3, almost 4 years. 2.5, we're there at $40 million. We built it. They did not come. And I would not have built a captive distribution at the time, but I would have been more aggressive about finding a distribution partner sooner. I felt that we would be able to, I had a big network out there, and yet what I didn't know was the ETF world and the active world were a universe apart, that my network had no relevance to the world I had entered, which was a bit of a shock to me. So I might have been a little more humble about that, number one, and done a little bit more homework, and maybe gotten a distribution partner a bit sooner. But we did try, we were trying. It's just we didn't think anyone really understood active management in the ETF world. And it did take 2.5 years to find that partner.
Any advice to women in asset management or in finance more generally?
Well, I think asset management and finance generally is a great place for women, especially if a woman or anyone, it's a man or a woman, can develop a track record. No one can take my track record from me, for better or worse. You know, some years have not been so great, but no one can take it away from me. And if you build one over a long enough period of time, and are successful, it's usually a ticket to more success. So I always say, try and figure out a way to measure your success in a way that no one can take it away from you. And that does not mean not being a team player. Being a part of a team that develops a great track record is really important. So many people say, wow, your industry seems to be quite lacking when it comes to women in portfolio management positions. And that is true. And I do think it's an unfortunate case of last in, first out in 2 periods, tech and telecom bust, 08, 09. And so that's unfortunate. But I have the highest regard for the industry. It is a heck of a lot of fun. It's extremely challenging. The world is our oyster. As long as you're not playing the old game, which is benchmark sensitivity, as long as you really are investing in the future. I think allocating capital to its highest and best use in terms of what we described earlier, increasing access, solving the world's problems. There can't be anything more satisfying from a
Cathie,
career point of view.
thank you so very much. It's been great talking to you.